Dear students, to complete the topic of decision making, we are now to start with chapter 6, which is related to relevant information for decision making with a focus on operational decisions. The first type of decisions we are going to speak about is to make or buy. And this is usually related to parts or sub-items related to a certain product that the company is producing. And if the company's got some idle capacities, it could be used into producing this product instead of buying it or purchasing it from some external supplier. According to that perspective, we will use one criteria, which means the less payment that we are going to pay or disperse for having that part. So if manufacturing cost will be less, we are going to choose it. If purchasing cost will be less, we are going to choose it. To apply this decision, sir, you can go through the given information about direct material, direct labor, and variable factory overhead and fixed factory overhead. And then we are provided with total cost. Of course, when we speak about this type of information, we must expect what items should be included into our decision model. Of course, all variable items related to our decision is going to be included. And when we speak about fixed cost, not to be included as of it's irrelevant because it's related to the past, unless a part of our fixed cost could be marked as avoidable, which means like variable cost could be a zero when we are to choose to buy this product from somewhere else. So according to the analysis provided, if we are to analyze our own information, we can find that the purchase cost is going to be $180,000, and the per unit is or per bottle is going to be $0.18 per bottle. And the direct costs related to producing or making that item is going to be direct material and direct labor, which means 60 or given $60,000 and $20,000 as of per bottle 0.06 and 0.02. And when we are heading to the overheads, we will find the two parts. The first as variable overhead or variable MOH, and the second part is fixed OH. Of course, the variable part will be included totally as of 40,000 as provided, and the fixed part is going to be divided into two levels. The first level, which is going to be included, which is the avoidable part, which is here given by $50,000. But the unavoidable part is going to be excluded totally, and this will lead to a total $170,000. But looking to buying for information, it's going to be totally $180,000. And this means that making is preferable because it's less costly than buying. And of course, to get to the decision, we are not also to stop at the two optional level, which means make or buy. Because when we make the decision of buying, we may find that there will be some unused or non-utilized or idle capacity according to the part that's called unavoidable fixed cost. So when we are to make use or rent or whatever, produce and sell for whatever product using this capacity, this means we are to achieve some profit or some income that will decrease the cost of the buying process or the buying alternative. And in our case, we can have this available as of this alternative, that we can make a profit out of $55,000, or can rent by $25,000. Of course, it's obvious that you are going to choose the first choice, which means to buy and use the facility for producing another product and achieving the $55,000, because the $55,000 will decrease the cost of $180,000 related to buying the product from others, which means the total cost is going to be 125. So in this schedule, we did reflect the 4 choices. First is to make, second is to buy without anything else, and third is to buy with renting the facility, and the last one, which is to buy and use the facility to produce another product. When making, the cost will be 170, and this is a total payment, so this is the amount related to that alternative. And when we are buy only, we are going to pay 180. So this means, according to these 2 only available alternatives, we can choose 170. But when we are to include the third and the fourth choices or alternatives or courses of action, we will find that the third one, we are going to pay the supplier $180,000, but we are going to get rent for $25,000, which means the total cost that we are going to pay is a $155,000. In the last case or last choice, if we are going to achieve income or whatever benefit from the product that we are going to sell, it's going to be $55,000 benefits. So this is to be reducing the $180,000 as of payment for the supplier. This will lead to a net cost to be sacrificed with $125,000, which is preferable as of the least costs available into making our own decision. To illustrate make or buy, we can go through this example. As of our company is going to purchase 8,000 units of a part, paying $25 per 1 unit, and when we are to produce, the total direct material is going to be $17,500 and $30,000 for direct labor and $14,000 for variable overhead, and take care about this part, which is fixed overhead, which is $33,500, but you have to take care that's totally avoidable. In this case, if you are going through these 2 parts only, we will multiply the 8,000 by the $25 per unit and compare the result with the summation of these 4 items. Of course, if we are to complete another step, we will make the comparison after reducing the payment when buying the part from the external supplier by $99,000 as of the rent that we are going to gain from renting the idle capacity according to making the buying decision. And as we can see, the solution. So if we are to get to the solution, if you are only with the buying part and making part without renting, so you will find that the cost of buying is going to be 200 and the cost of making is going to be 95 as illustrated. And according to that, when we are to make the comparison, we are going to choose the 95 as of the lowest costs. But when we are to get to the buying with rental, we are going to find that the rental income will be deducted from the cost of buying the material from the external supplier, and this will lead to a net cost of 80,000. When we are to make the comparison in between the 80,000 and the $95,000, we are going to choose, of course, to buy the product from the external supplier with renting the non-utilized power or capacity. The second decision is related when we have lines of production, when we have different departments or different branches, and one of them is suffering losses. So can we take the decision to shut down or drop this part, this product, this line, this wherever department, and keep the others working, and maybe to add the unavoidable fixed cost, the remaining fixed cost after shutting down or dropping that part or that product or that department or that whatever to some other departments, or use its own unavoidable fixed costs to achieve some contribution margin to cover this cost. So according to this, we are going to go through the next coming case. We have some wherever supermarket or wherever with three different departments. One of them is a grocery, and the second is a general merchandise, and the third is going to be drugs. So if we are to look, we will find that these departments, or to that store, is providing the next financial data. We have a total and a grocery department, and general merchandise department, and drugs department, and this is the total, providing that the operating income is going to be 35. Yes, but of course we will find that we have a problem. This problem goes that this department, which is grocery, is suffering losses as of 10. Okay, when we get to the matter of shutting down this part, which is grocery, we need to close this part, drop this part. Will this be benefitable for the organization? What is the meaning of the word benefitable? Benefitable means that the 35 is not to go down, not to be less than 35 any case. If it's good below 35, this means it's not good for the company or for the store to drop the grocery department. So to analyze that, we are going to see, or to make sure that the problem lies with avoidable and unavoidable fixed cost. Always the problem lies with that part. So we will delete the revenues related to that department and delete all variable and all avoidable fixed costs related to that department, but we cannot delete the unavoidable fixed cost. So one main problem or obstacle, if this unavoidable fixed cost is going to remain, it's going to affect the net operating income that's going to be achieved from the store totally. And it will reduce its own profit. So if we can utilize or use this unavoidable fixed cost, can this lead to another way of achieving a higher level of operating income, or at least keep it as it is, to go with the decision of dropping this department? So we will see this as it comes. If we are to drop the department without doing anything else, we will see that the total before change is the main column that we are going to keep as it was, and then we are to drop the department that we are going to speak about, which was suffering losses. We are to reduce the 1,900 by the 1,000, like the sales of the department dropped. This means the after change is going to be only 900 revenue or sales revenue, and the variable expense is going to be from 1,420 to 620 after dropping the 800 as of variable expense. This means the contribution margin is going to drop from 480 to 280 after deduction of the 200 related to the grocery department. And when we seek this part, which is very important, the avoidable fixed cost, from 265 we are dropping 150. This means to go to 115. So this will lead to the contribution margin, and the contribution margin before the change or before dropping the department was 215. Now we are to drop the contribution that's going to lead from the department dropped, which is 50. This will lead to 165. But the problem lies with the unavoidable expenses. Here goes the problem. You can find that we cannot drop any part of this. We have to keep it because it's unavoidable. So this means the 180 stand complete as the total after change. This will lead to a change into net income from income into suffering losses by 15. So this is not expected to happen or accepted when we drop, so we cannot take the decision to drop that department under the given information, unless we are going to make utilize the fixed cost that's going to be kept as unavoidable fixed costs. So when we head to that analysis, we will find that we have a choice of using or increasing sales by using this unavoidable fixed cost by $500,000, generating a 30% contribution margin. So we have to wait and think about this percentage. When we speak about 30% contribution margin, this means a 70% will be as of variable cost out of the $500,000 generated as of sales. And we have to see the next coming item, which is the avoidable fixed cost, which is going to be $70,000. So when we are to apply this, we are to prepare our own schedule back again with the first column as it is, the amounts or the items given, and then the total before change or before dropping the department, which is grocery, and this will be the same as provided before, and dropping grocery will be the same also as provided before, but the new added column will be here as of expand the general merchandise. We are only going to provide the new information related to the part, which means increasing sales by 500, and the 70% variable cost is going to be 350, and then the contribution margin will be 150, and then the avoidable fixed cost as provided to the case is 70. This means we are providing ourselves with profit contributed to the store, which is 80. And of course this 80 when added to the 50 and when it's added to the 215 after reducing the 50, which is the profit that we are going to drop from dropping the grocery department, this will lead to a net as of 245. When we are going to reduce the fixed unavoidable cost, which is going to be the 180 as it was provided earlier, this will lead to a profit or a net operating income out of 65, which is preferable, and this means we are going to drop the department of grocery with expanding the general merchandise only. But if not to expand the general merchandise, this means we are not to accept the dropping of the grocery department, because this will lead to a loss of 15 as shown earlier. For you, sir, to make sure that you did understand the case of dropping and adding, please try to solve this example and then compare your results with the given in the next slide. Of course, this is about 3 departments available into whatever type of business, any company, and Department C is suffering losses by 155, so we are thinking as a management, as a board of directors, to drop this department, and then we can use the unavoidable fixed costs into doubling, as provided to the case, doubling the sales of Department T without increasing its fixed costs. So this means before going to your own analysis, you prepare a schedule. This schedule includes the items provided to you, which will be sales, variable expense, unavoidable and avoidable, and operating income, and so on. Answer. First column, you have to prepare it yourself by getting the total of the 3 departments together before doing the dropping and adding part, as provided. You can see, you will start your own solution by preparing this schedule and provide the data or items given to you as of sales minus variable costs lead to contribution minus avoidable fixed cost, and then minus unavoidable fixed cost lead to net operating income. Of course, the first column will be added by you, and it's calculated by adding all the items as of lines or as of rows. So this will be the total sales, the total variable, and so on, under reaching the net operating income, the as of total, which is calculated here by 343. And then we are going to drop or delete the department with or suffering losses, which means we are going to provide all the data included within the column of this department, but one main cell, which is the unavoidable fixed cost. This is not to be included. It will be here as of a 0. We cannot delete this type of fixed cost. We will find that the net operating income is avoidable with 85, which is encouraging to delete this department. We are not going to turn into losses mainly when we drop it, because early when we make it working or under processing, we were suffering losses. Now we are turning ourselves into a profit. But with expanding department business, other department business using the fixed cost, we will add only the new, because the old items related to that department which was working earlier is included already into the first column. So we are only add here the new the new revenue, the new variable cost, the new contribution only. And if there is any new and not old, new fixed cost only, we can add it here. So here we have the sales provided as of the doubling level, but for the new items added only. It's 1,120 and 260 for variable and 860 for the contribution. So the total contribution will be 860. So take care. Our total net operating income is going to be 1,118, which means we are going to accept the decision of dropping the department and expanding our own business into the other department. And now heading to the third decision types, which means joint product costs, or sell at split, or process further and sell with higher prices. This means some products like meat or dairy or oil and gas products will reach point of a split off, which means a one source will lead to separate products. We can sell them directly at the point of split off with a certain price, or we can process each one of them further with additional costs, and this will lead to a higher pricing level. So are we to sell them at split off and achieve the profit that we are going to calculate at the point, or further processing them and then selling them with a higher prices to achieve maybe a greater level of profit? So when we have to go for this, we must understand that the decision must be to compare two things. The difference between the two selling prices at the two point of sales, the point of split off and the point two, which is related to after processing, and the cost of further processing. So this is the main decision that we are going to speak about as of a criteria. If you are looking to this given information, the joint cost here is 100,000, and here we have the selling price of product A is for 90, and for P or for Y is for 30,000. So the total is going to be 120. This means we are achieving profit of $20,000. If we are to process further as the given information, we are provided that suppose the 500 liters of Y can be processed further and sold to the plastics industry. The additional processing cost, this is the most important part. The cost to complete is 0.08 per liter, which means a total of $40,000. So this is obvious. A $40,000 is the processing further cost. The net sales price for that type is going to be 0.16 per liter, which means a total of 80,000. So when we make the difference between the selling prices or the total revenue at this point, which is 80, and the total revenue at the first point, which was 30, the difference will be $50,000, which exceeds the cost of further processing, which is the 40,000. So this means we are going to accept. And here is your analysis. If you are going to sell only at split off, we are going to achieve a 30,000, which is the revenue. We are going to process further, we are going to go for $80,000 as of revenue. So the difference is going to be $50,000. But the cost of completing is going to be 40, and this means when we are to match or make the comparisons between the 50 and the 40, we are achieving a net income or a profit of $10,000. This means we are to accept this for further processing case. To illustrate this, you can solve this question and try to make a comparison between your answers and the provided answers in the next slide. Here you have three products, sir, A, B, C, and here you have a sales value at split off, and here you have a sales value at completion, which means after processing. So first, sir, we can get the difference of these two columns. For the 17,700 minus the 15,500, and the 23 minus the 18, and the 37,500 minus the 24. This difference is the difference in revenue, or the exceeding part of revenue that's going to be achieved after processing further and selling at the second point. And then we must compare that difference with one thing, with this cost for each and every product alone, and this is going to be shown in the solution provided into the next slide. So this is the first product. This is additional revenue, the difference between the 17,700 and the 15,500, which is 2,200. And you can find that the additional cost is the same amount. This means the net profit is going to be 0. This means it's not our decision as of financial people. We will leave it to the management. And then we will head to product B. We will find that the additional revenue is going to be 5,000, but the additional cost is 8,000. This means we are suffering losses by 3,000. We are not to take that decision to complete with this product. And for C, we will see that the net profit according to applying the rules is going to be 2,000. And this means that when making the decision to complete only product C, this means our profit is going to increase totally by 2,000. Our profit earlier was $27,500. Now is going to be $29,500. But take care of one main important perspective. If the question was you must complete for the 3 products at the same time if you need to, this means you cannot accept, because when we accumulate these 3 results as of 0 and negative 3,000 and positive 2,000, the yield will be a negative 1,000. So only we will accept to complete of each product is separate from others. So we can complete only for C and reject it for B and A, or for B because of A is not to affect anything as of a financial perspective. Heading to the last decision, which is to replace an old equipment with a one that's just as a replacement, not as a purchasing of a new equipment. Of course, this means we are to understand what will be the items included in our decision model. Of course, when we are to seek these items, we will find 4 main items. These 4 items will be as provided into the second slide. But here first, the information that will be provided to you. This is the old machine, and this is the replacement machine, or the machine that's going to replace the old one. Of course, the replacement machine will be a refurbished one, not a new, complete new one. It's not like that. It's a refurbished one. So we will find that the original cost is available for both. This is 10, this is 8. We will find that the useful life here is 10 and here is 4, but take care of one main rule to apply this decision model, that the current age of the old one, which is 6, makes the life remaining as if useful related to that old machine is 4, which means equal completely with the replacement machine useful life, which is the conditional way to make that decision. And then the accumulated depreciation only for the old one, it's 6,000, and the book value is 4,000, and the disposal value is 2,500, and the annual cash operating cost is 5,000 with the old machine and the 3,000 annually for the replacement machine. Of course, before we do anything, we must understand that we are not to take into consideration whatever happened in the past, as we usually mention as of relevant items to be included with our model. So the most important part is to include the items that's going to happen or will reflect in the future. So the original cost of the old one is not to be included, but only the replacement one, because it will happen in the future. And we are not to include the parts that's related to the book value. It's not accepted to be available, or the accumulated depreciation. Sorry, but we are going to take into consideration the disposal value, of course, and the annual cash operating cost, as mentioned in the next slide. Here we have the disposal value will be included, the gain or loss on disposal will be included, and the cost of new equipment will be included. What about the book value? If we are to include it, we must include it into both columns, the related one with the old machine and the related one with the new machine, or the refurbished machine, which is the replacement one, as we are going to see into the illustration related to the solution here. So if we see the cash operating cost, it's going to be 20 and 12. These are the 2 columns, and here we find the third, which is result will be the difference. And the difference means what comes for the acceptance of the decision, which here the replacement machine will cost us 12, but the one that's the old one to keep will cost us 20. So we have the difference of 8 in favor to the replacement machine. When we speak about depreciation, we will find that we did provide it into the 2 columns, so there will be no effect in the difference level. But we are taking into consideration the disposal value, which means it will happen in the future. The disposal value will be available under the replacement one, because when we are disposing the old one, it will never be existing anymore, so no amounts could be available under this column, but it will be available only under the new one to lower the cost of this alternative by the 2,500. And for the acquisition cost, it will be only the 8,000 available to the replacement machine or the refurbished machine. So when we make the differences, we will find that comparing the 12 with the 20 means it's 8,000 favorable as a difference, and for the 2,500 it's also favorable for a 2,500 because it means it will decrease the cost of getting the new machine or the refurbished machine. And for the acquisition cost, this is not favorable at all because it's a cash out, which means the $8,000. But the net, which is a very important one, favorable or unfavorable, it's favorable because it will be an inflow for a 2,500. So the 8,000 will be inflow, the 5,000 will be inflow, but the 8,000 will be outflow. So it's favorable for the organization to apply or to take the decision to replace the old machine with a refurbished one. And then, sir, you can find yourself facing this example too to provide a solution. And if you are to apply this, you will prepare your own schedule for 4 columns. The first column will be for items, and then you will have the old machine and then the replacement equipment or machine. Of course, this is the original cost. You will only include the 40,000 as an outflow, which is unfavorable. And we must make sure that the difference between these 12 and 7 years, these 12, sorry, and 5 years will be 7 years related to the coming useful life of the refurbished machine or the replacement equipment as provided here. We are not to make importance of the book value, but we are to make importance of the $30,000 disposal value, which is going to be inflow favorable also for the replacement equipment. But when we go to the annual cash operating cost, take care about this word annual. So we must multiply the 10,000 or the 9,000 by the years or the life which is coming, which is going to be in both cases 7 years, as we can find in the next. So applying this, we will find that the cash operating cost is going to be favorable for the replacement part by 7 inflows, and the 30 for the disposal will be also favorable as inflows for a 37, but the acquisition cost will be 40. This means outflow, which is unfavorable, and the net is going to be the 3,000, which is going to be unfavorable to make that decision. So we are to keep the old machine or equipment and not to replace it with the refurbished one.